Have you ever thought that your paycheck looks smaller than anticipated? Each time you get paid, you'll notice that there are some deductions that come off. With all these acronyms, it's quite difficult to understand what they actually mean and how these deductions might actually benefit you in the future. In this video, we're going to look at a couple of those acronyms, what those deductions mean, and how they might benefit you long down the road. Before we hop into those deductions, we're going to go over what a pay stub is. A quick summary of a pay stub: essentially it is the amount of pay that you have during a given pay period and how it is distributed. There are generally three main sections of a pay stub. The first being how much you actually get paid. And this is divided based on your gross pay and your net pay. Your gross pay is essentially an hourly rate or your salary with nothing taken off, no deductions, no taxes, nothing. Your net pay is the amount that you actually receive in your pocket after tax is taken off and those deductions are made. The second section is the amount of tax that is owed. This is a combination of the federal tax rate as well as your provincial tax rate. And lastly, there will be a column of all the other deductions that are going to be made, which will be the primary focus of this video. Now there are three deductions that we're really going to hone in today. The first being employment insurance, or EI. The second being Canada Pension Plan, or CPP. And the third being other deductions which may or may not apply to you. Number one, employment insurance, or EI. This contribution helps fund those who might have lost their job, are on disability, or are potentially on maternity leave. Should you lose your job, you may be entitled to EI benefits, which you'll be grateful for at that time because it's a little bit of income to supplement the lost job and also allow you to search for work. This benefit is most common for seasonal workers who aren't able to find work during the off season. Now these deductions that we're going to talk about typically have a contribution rate. With employment insurance, the 2023 contribution rate is 1.63% that you put in off your pay stub. So a percentage comes off your pay stub. It's up to a maximum, so you can't contribute over the maximum. But your employer also puts in a portion of their income as well. And this amount is typically 1.4 times what the employee puts in, up to a maximum. Number two, we're going to talk about Canada Pension Plan, or CPP. If you are 18 years or older or under 65, you are considered to be in pensionable employment, which means that if you're making income, you're contributing to CPP. The whole concept of CPP is to contribute to it during your working years, have professionals manage that money, invest it, allow it to grow, so that one day when you hit retirement, you're able to actually reap the rewards of contributing to the plan. CPP is generally supposed to replace around 25% of the average Canadian's pre-retirement income. If you're ever curious about CPP and how your money is being invested, you can go online, look up CPP investments. You can see everything about it, who they are, how they invest the money that you contribute, what performance is, how big the actual fund is. It's around $536 billion as of last year end. And you can look at all these different information that might actually be important or you might actually find significant. Now just like employment insurance, CPP has a contribution rate. This rate's a little bit different than employment insurance, but it is your contribution into the plan to eventually be able to reap the rewards into retirement. The contribution rate for 2023 is 5.95%. For every dollar you put in, your employer is also putting another dollar in. So with 5.95% coming from your end and 5.95% coming from your employer's end, a total of 11.9% is going into CPP. Now, if you're self-employed, you're both considered to be an employee and an employer at that point, so you're contributing that full 11.9% of your own. One thing to note is this is only applicable to income. So for self-employed individuals, if you're getting paid dividend income, this is not considered pensionable earnings for CPP. Now, just like EI, there is a maximum amount of contribution that you can actually put towards CPP. The maximum amount that you can contribute each year is called the Yearly Maximum Pensionable Earnings, or YMPE for short. And there's a little bit of a calculation that the government determines when contributing the maximum. So for 2023, the maximum amount, or the maximum amount of income that you need to contribute the max is $66,600. Now, based on the formula, that's $66,600 of annual income minus the basic exemption, which is $3,500, times the percentage or the contribution rate, which is 5.95%, it leaves you with $3,754 contributed towards CPP. So that is the maximum amount that you can actually contribute to the plan. If you're making above and beyond $66,600, you're not contributing anything else over. The next important thing is CPP is an entitled benefit. You can actually go on to Service Canada, look up how much you've actually contributed to the plan and what you might potentially be entitled to when you hit 65. Now these are some assumptions based on your current income and that being the same throughout till 65, but it gives you a general idea of how much money you might receive into retirement. CPP is one of those things where you might not see the benefit right now. You might see it as a deduction you don't understand, but later in life when you hit retirement, you're going to be very thankful that you contribute to this plan. Next, we're going to talk about some other deductions that you might see in your pay stub or you might not see. The first being employer group insurance. Now, some of you might have a group plan with your employer and you might have the option to buy additional insurance through that group plan. Now, with that in mind, if you chose to have additional insurance, you might see it as a deduction coming off your pay stub. The second one might be group retirement plans. So instead of contributing to an RSP where money has already been taken off of your pay stub, you contribute, then later when you file taxes, you get a tax credit. You're going to contribute to it through your group plan. It's going to be taken off as a deduction and you're not going to receive a tax credit come tax time, but you're going to have a lower reportable income when you file taxes. The third might be same sort of investment vehicle, but a stock purchase plan you might see as a deduction on your pay stub. And the last, if you work for or you're a part of a union, like a teacher, a nurse, a police officer, you might have union or professional dues that come as a deduction off your pay stub. Thank you very much for listening, guys. We hope that you were able to understand a bit more about the deductions on your pay stub, a little bit more about the acronyms involved with that, and have more clarity around where's my money going after it's all said and done. We hope you enjoyed the video. Look forward to the next one.